The Bank of England wants to limit how much stablecoins you can own, and the crypto world is not impressed. According to the Financial Times, the central bank is proposing strict ownership caps for stablecoins in the UK, with individuals limited to as little as £10,000 to £20,000, and businesses capped at around £10 million. Now, critics are saying that it's unworkable, it's anti-innovation, and could drive crypto business abroad, marking the UK as tougher than both the US and the EU. So, what's going on here? Why is the Bank of England trying to cap stablecoin holdings, and why are industry leaders calling it a disaster in the making? Let's break it down. So, the Financial Times reported this week that the Bank of England is preparing to impose limits on so-called systemic stablecoins. That means that any stablecoin that's already widely used in payments or expected to become so would be subject to ownership caps. Now, under the plan, individuals could only hold between £10,000 and £20,000 worth of stablecoins, and businesses around £10 million. And the bank is arguing here that the restrictions are about financial stability. Officials have said that if stablecoins become too popular too quickly, money could flow out of banks and into these digital tokens, weakening credit, disrupting lending, and even threatening financial stability. And Sasha Mills, who is the bank's executive director for financial market infrastructure, told the FT that these limits would help mitigate risks from sudden deposit withdrawals as new payment systems scale up. Now, so far, that sounds like a precautionary step, but people, critics are saying that it's a major overreach. And we've now got industry voices that are calling this plan completely, unworkable. Tom Duff Gordon, who is Coinbase's Vice President of International Policy, told the Financial Times that imposing caps on stablecoins is bad for UK savers, it's bad for the city, and it's bad for sterling. He argued that no other major jurisdiction, not the US, not the EU, has anything like this. We even had Simon Jennings from the UK Crypto Asset Business Council warning that enforcement would be nearly impossible without systems like digital IDs to track who owns that. We then had Ricardo Tordero Ricci from the Payments Association, who said it makes no sense to cap stablecoin ownership when there are no caps on cash or bank deposits. And people are saying that these rules would send the message that the UK isn't open for crypto business and that it's becoming a tougher regulatory environment than either the US or Europe. And this is really where it gets interesting, because while the Bank of England is talking about caps, the rest of the world seems to be going in, the complete opposite way. In the US, they have the Genius Act, which was signed into law back in July, and it sets national rules for stablecoin issuers, things like licensing, reserve requirements, and redemption standards, but it doesn't put any limits on how much a person or business can hold. And the idea there is to regulate the issuers, not the users. And across the Atlantic, the European Union's MiCA Act is now fully in force. MiCA introduced sort of new rules for stablecoins or e-money tokens in June 2024, followed by broader crypto regulations in December. And again, the EU did not cap ownership. Instead, it focused on reserves, transparency, and oversight by national regulators. So, in other words, both the US and Europe are saying, make sure that stablecoins are properly backed and well managed, but don't tell people how much of them they can own. Meanwhile, the UK is potentially doing the exact opposite. And this could very well backfire, because the concern from the industry is that these caps could have the opposite effect of what the bank intends. If limits make stablecoins less practical for payments or savings, UK consumers and businesses might just move their activity elsewhere, to offshore exchanges or foreign issued tokens. So that means less oversight, less tax revenue, and less control for UK regulators, which is exactly what they don't want. And not only that, but it can also harm the City of London's ambitions to be a global crypto hub, which is something but both the government and the Treasury have repeatedly promised to support. Another thing that Coinbase was saying, or warning, was that this policy would harm sterling, because stablecoins pegged to the pound can struggle to gain adoption if users cannot hold meaningful amounts. There are other people that are worried that it could undermine innovation in digital payments, just as the UK is trying to launch its digital pound lab and explore central bank digital currency design. And even the bank itself has suggested that caps might be transitional, meaning that they could be temporary while the system adjusts. But, I worry that once it's in place, it'll be very difficult to unwind. So I want to hear from you guys. Is the Bank of England overreaching here, or are they just being cautious? People are saying that caps can prevent a shock to the banking system, but opponents to it are arguing that they're anti-competitive, unenforceable, and could send the UK's crypto scene straight into exile. If Britain wants to be a leader in digital finance, then it needs to be clear, have workable rules, no arbitrary limits that make innovation impossible. Now, as always, we'll keep an eye on how this develops, because if the Bank of England pushes ahead, the ripple effects could reshape crypto adoption in the UK for years to come. If you found this video useful, don't forget to like, subscribe, and hit the bell for more updates on the future of crypto regulation in the UK and beyond. Thanks for watching, thanks for listening, and I'll see you in the next one.